All right. Good morning, and thank you all for joining today. Hope everybody is doing well and staying safe and enjoying the end of summer here. Today we're going to talk a little bit about the elections, and in particular with the elections, we're going to talk about taxes. Before we get into that, just wanted to kind of give a brief update as to where the markets are. Last week was not quite too exciting, but overall, all the major indices ended positive. The S&P was up just about 0.7%. The Dow was up just under 2% last week, which year to date brings the S&P actually up about 5%. And the Dow still hanging in the negatives, but getting pretty close back to even at around negative 2%. And the Nasdaq has been the surprise here with year to date up 25%, and just really since the bottom just picked up a considerable amount of steam, and these tech companies have been running. So that's kind of where we are in the markets. If we kind of turn our focus now and talk about the elections, we've been getting, I think, a lot of questions from clients in either review meetings or they've called up because it's election season, and it's obviously all over the news. And one of the big things that is always focused on in an election period is what potential changes could be to taxes, and then what are the implications of that to the stock market. Which, if you if you think about, there's very different kind of ecosystems, but they all are related. So you have the economy, you have the stock market, and then you have our tax code. And although all three of them are separate, there certainly are correlations between them, and they certainly interact with each other. So I thought this would be a good idea to talk about today, as it seems to be somewhat of a question that people have brought up. And the election day is, I think it's about 11 weeks or so away, so it's kind of right on the horizon. And although that's probably a long time for the candidates, and certainly lots can change in the polls, there's a lot at stake in this election, with the White House up for grabs, and 1/3 of the Senate and the entire House of Representatives up for grabs. This election is pretty significant, particularly because these two presidential candidates have very different points of views in policy, in perspectives, and specifically their approach and their thoughts, their perspective on taxes. I think if we looked at some of the polling data right now, the polling averages put former Vice President Biden, I think most recently I saw it was like 7 points ahead of President Trump. And I was looking at a report from one of those data gurus. It's the Nate Silver's model. Says that Trump has about a 30% chance of winning, which ironically is about what they had called in the 2016 election. So certainly anything can happen, even if it looks like Biden's current lead is pretty significant. There's obviously a lot of reasons to doubt the polls, but certainly it's never a waste of time, I think, to look at what tax policies could be if excuse me, if a different administration were to enter, and how that then affects you and how that affects the economy. I think this is especially true today, with many people predicting massive disruption in the markets if President Biden wins, and especially if he were to achieve all of his policy objectives. I think it was several weeks ago, there was a top story. I don't remember where it aired, whether it was Fox News or maybe even Yahoo Finance, that brought up a lot of Biden's proposed tax policies. And I think we got several phone calls that day saying, "Oh my gosh, is this something we should be worried about?" Which kind of made me think that this may be a good opportunity for one of these conference calls. So let's kind of jump into this a little bit, and I'll give you some of our thoughts. And obviously, there's a lot of variables, and we're really looking pretty far into the future, even though the elections are around the corner. But let's just kind of run through a couple things. So the first, I think, important part of this is, let's think of a scenario that if Biden wins the presidency, he takes the White House, but the Republicans keep the Senate. Because we always have to remember that the president, for all intents and purposes, doesn't create tax laws. Congress does. So it's very important to not only take into consideration who's running the White House, but who has control of the House and the Senate. So if we think about if Biden wins the White House and the Republicans keep the Senate, right now the Republicans have 53 seats in the Senate. I think we have a pretty clear answer of what this would look like, which would be probably very little change. I just don't see a whole lot of scenarios where, with a Republican majority in the Senate, that they would let anything really get through in any potential Biden tax proposals. Obviously, we don't know for sure, and certainly, there's always possibilities. But the way that these have gone in the past, it just seems like if the Republicans have control of the Senate, either things are going to get very watered down, or they're just going to get blocked left and right. I don't see any way that they would allow tax increases, I guess I should say. They would probably be killed dead on arrival. The one change that Biden might be able to make is enlarging the deduction for state and local taxes. That's something that he's talked about. And I think many in the Republican Party would oppose that. But it would lighten taxes more for residents of higher tax states than lower tax states. But it still is a tax cut. So, it's not a hike. So I think that could be something that could go through. Although, like I had mentioned, the benefit really is certainly more for people in higher tax states than in lower. So it's not going to be as impactful for many people. I guess what many investors and many people are kind of more focused on is the other scenario, where Biden wins and the Democrats also take the Senate. Now, in this scenario, Democrats could do a lot. And I guess the question is, what would those impacts be? And what do we think they would be able to get through? So one thing that's been talked about, and is certainly a possibility, is they could use the special budgets process on Capitol Hill to raise taxes permanently, meaning no sunset provisions, which President Clinton did in 1993, where oftentimes a lot of tax changes that have happened have been sunsetted, where there's changes that happen over a period of time and then they revert. But it's possible that he could do that. They've made a lot of proposals on various aspects. I want to bring up, I think, 5 that are probably the most meaningful or most impactful. The first is they've talked about raising the top income tax rate on regular income back up to 39.6% from where it is now at 37%. So that's one. They've discussed raising the corporate tax rate from 28% from 21%. And they've talked about ending the step-up basis at death. What that relates to is, if you own an asset, let's just say it's Apple stock, and it's in a non-IRA account, and you bought it for $10,000, and by the time you die, it's worth $100,000. Your basis is 10. Your value is 100. Normally, if you were to sell that investment, you would have a $90,000 capital gain. That would be taxable. But if you die before selling that, your beneficiaries inherit that with a reset in basis, meaning your $10,000 basis now goes up to 100,000. So all of that taxability, all of that capital gain is basically washed out when you die. And theoretically, your beneficiaries could sell that day one with no tax gain. So they proposed ending that step up basis. Another thing they've talked about is treating long-term capital gains and qualified dividends as regular income. But I think they did put a provision on that's primarily going to be for high income earners. I think they proposed over $1 million of income. So back to the capital gains example, typically capital gains are going to be paid at a lower tax than ordinary income. So depending on your tax bracket, between 15 or 20% on capital gains, which for a lot of people, that certainly could be way less than their ordinary tax bracket income. So that proposal would essentially then remove the discount per se on capital gains tax and essentially treat that as income. The last thing is applying Social Security payroll tax on incomes over $400,000. And I'll get into a little bit more detail on this right now, but you know that FICA tax that comes out of your paycheck if you're a W-2 employee, and also out of your employer's paycheck in equal amounts. Or if you are self-employed, you end up paying both sides, the employee and the employer side. But there are limits to the income amount. And once you reach that limit, that FICA tax, at least the Social Security side, the Medicare side continues, but the Social Security side stops. And you basically pay up to a certain amount, and then for that tax year, you no longer pay that. So he has proposed applying the Social Security tax for income over $400,000 all the way through. So if the Democrats win the Senate and a Biden administration is likely to be successful, I think, at raising the personal rate and the corporate rate as well. I think that those are two that would likely get through. We think that lifting that top income tax rate back to 39.6% would probably have a negative economic impact on growth. I mean, higher taxes always do, but I don't necessarily think it's going to be substantial. I think the effects would be pretty small. The amount of people that it impacts and the difference between the two brackets, 37 to 39.6, I just don't think is enough to cause significant damage to the economy. And quite frankly, that's where the rates were under Clinton and where they were under President Obama's second term. And we didn't have a recession in either of those periods. So I just don't see any reason why it would be any different if it happens now. And historically, even 39.6% has been somewhat low, although a bit higher than it is right now. Raising the corporation rate to 28%, I think, is kind of more like looking at it a glass half full. Obviously, corporations and I think in general, the economy and probably even the stock market would like to see corporate rates stay at 21%. But I also don't think that anybody thought that they would stay there forever. This was kind of a big deal when they were lowered. And as soon as they were, it was like every Democrat was essentially salivating to have the opportunity to bring these back up, because and I'm not trying to get political in this. That's not where I'm coming from this, but it's kind of a generalization that the left likes to see corporations pay more taxes. So it's almost no surprise if this happens. That being said, the corporate tax rate was stuck at 35% from the early 90s through 2017. So even 28, relatively speaking, from a glass half full perspective, is pretty darn reasonable. And it hadn't been as low as 21% since the 1930s. And that's why it was such a big deal. So I think that, if you think about the market, it's a discounting machine. It's always kind of looking at, well, what's the worst case scenario, what historically has been the case, and looking at 28 versus 35 actually looks pretty darn good. And I think the market will react that way to it. Obviously, it's not great for corporations to pay more taxes, but at the same time, it could be a whole lot worse. And if the Democrats do take back the power and they only raise it to 28%, I think that's actually a win for the stock market, because it also kind of sets the precedent for the future. So if we look at like way into the future, and right now 28% seems high and 21% seems too low. And by raising, if the administration were to raise from 21 to 28, it almost sets the precedence for future policy debates on the corporate tax, between 21 and 28, and not 35, because no one's mentioned 35. And I think to some degree, if there's all this debate and struggle to get it to 28, it's going to be really difficult to ever get that back to 35. So I almost want to say that could be a somewhat of a glass half full win for the stock market, because it kind of sets the boundaries and levels the playing field that, hey, 28's where we're going to be going, not 35. And that's good. Not as good as 21%, but it's good that, I think you know what I mean. Anyways, Biden wants to apply that minimum. Oh, okay, so let me switch gears here. So kind of with regards to corporate taxes as well. And this one's kind of a trickier one, but he wants to apply a minimum profits tax of 15% on larger companies using essentially their GAAP earnings, which is kind of like how corporations do their accounting. The backstory on this is there's what a corporation shows in their accounting isn't always the taxes that they pay. And that, for all intents and purposes, that's legal. So a company could show high earnings, which they want to, because that shows their shareholders that the company is doing well and doing profitable. So when companies are releasing earnings, they want their accounting to show that their company is healthy and their cash flow is good and they're earning money. But they don't want to pay a lot in taxes. So through the tax code, then they start utilizing opportunities to reduce their taxable income. And Biden's kind of saying, hey, if you're going to show your general accounting to be here, then you should have to pay taxes kind of based on that. And the idea is that some companies are using legitimate tax maneuvers, like expensing investments, so they show lower or no tax profits, even though their accounting earnings are high. So because through GAAP accounting, you can depreciate investments over time, and then there becomes a discrepancy between your actual taxation and what your earnings really are. But companies would, I think, if this were to happen, companies are just going to react by, I mean, I guess for lack of a better word, manipulating the books. It's still probably, I'm not talking about fraud, but it would be within the tax codes, because just because you say you have to essentially pay taxes based on your accounting, but if you don't change all of the opportunities to kind of shuffle things around on your accounting books, then companies are going to figure out a way to get around this. They're going to react by showing weaker profits, knowing that analysts and savvy investors who follow their company and follow their stock are going to see through it. It should be relatively obvious. And again, it's not an illegal practice, but basically they would find those opportunities to just show less profit through their accounting, and investors are basically going to catch on and know that, okay, there was a drop, but it's basically on paper. There's all sorts of other things companies can do, spinning off big investment projects to other companies that maybe have larger taxable profits, and they can lease things back and forth. And I could go on forever about the various opportunities that corporations could do to try to reduce their GAAP when really, for all intents and purposes, it's not, it's nothing material. So I don't necessarily also think that that is something that's going to be significant or substantial. Um, let's talk about capital gains. Although the Biden administration is proposing and would want to raise taxes on capital gains, I think this is going to be a really hard one. He probably needs a pretty clear Senate majority to get that through. If the Democrats were to win the Senate but have a narrow win, I think it's going to be a tough time to get that through. Especially eliminating the step up at death, or treating capital gains as ordinary income, those in particular. I think it's going to be a little hard just because that one seems to get bipartisan support both ways, to some degree. Eliminating the step up at death basis also it's an administrative nightmare, and not just for the wealthy. So the backstory on that is, if you're talking about generations and leaving positions to people in different generations, it's very common, and it's gotten better, but it's still very common to just not have good records. I mean, quite frankly, people don't know what their Exxon stock was that was purchased in 1970, and when it's inherited, who knows? And what do you do then? And the IRS is relatively vague with regards to how you clean that up. So I think one, it's an administrative nightmare. And it impacts far more than the wealthy. So I think more likely the Senate would probably reduce the exemption amount for state tax. I think that's an easy one to kind of get through without necessarily messing with capital gains or basis step-ups. I think more troublesome than the basis step-up is the capital gains. And treating capital gains or qualified dividends as regular income, at least for on those making $1 million or more. For dividends, let's think about that. That's going to unravel about 20 years of tax policy that really kind of focuses on reducing double taxation on dividends, and that's kind of where all this started from. So monies are taxed at the corporate level when they earn the profit, and then they're taxed again at the personal level. So essentially, you're getting this really true double taxation if you're going to then tax dividends, qualified dividends, at the ordinary income rates. And on long-term capital gains rates haven't been at 39.6% since the Carter administration. And so, I think that one is probably more troublesome than the basis step up at death. It would be a disincentive for investors for sure. And given that the economy, and I guess this is kind of the key piece here, I think given that the economy is certainly going to be far from being healed from all of the government shutdowns and the pandemic in 2021, I really think that the Biden administration is going to be able to rally all of the moderate Democrats without having just a clear win in the Senate to get that tax hike through. I think it's going to be a tough one to sell in a quote unquote struggling economy, or at least let's say a recovering economy, to be able to make that shift. If we look at like President Obama, he had 59 Senate votes and a large majority in the House. And when he became president in 2009, he inherited the Bush tax codes, and he wasn't able to unwind those for a long time. So President Obama hops in 2009. We're kind of just starting the recovery, and pretty much right smack, dab in the middle of the economic meltdown of the real estate and credit markets of 2008. everybody's thinking, oh my gosh, Obama's now elected. He's going to unwind all of the Bush tax cuts. He wasn't able to until 2013. And even then, he really was only able to partially adjust most of the Bush tax cuts. And quite frankly, I think the majority of what was important in those tax cuts, or I guess substantial, I should say, in those tax cuts stayed. So Obama got some of the top tax brackets increased, and he got the Medicare tax put on, some changes to capital gains, but nothing significant. And really, quite frankly, the system at that time, even with the changes Obama made, really still resembled, I think, the Bush tax system more than they did a whole new set of tax laws. And I think a lot of that had to do with the fact that even with a Democratic president and some Senate control, that people were just really concerned about making significant tax changes after a recession. And I think we're going to see that now. So, is that a silver lining to a recession coming before a presidential election? Maybe. There's going to be that fear in those politicians' minds that is now the right time to have significant tax increases, even in a Democratic-held Senate. I think that that's certainly a possibility. So we'll see. The most aggressive proposal is the last one I had mentioned, which is that Social Security tax on regular earnings above 400,000. So right now, at present, Social Security tax is 6.2% for both the employee and the employer. So if you are just an employee, then you pay 6.2% on what is called your wage base, which is in 2020, your earnings up to $137,700. If you earn more than that in that tax year, then that 6.2% Social Security tax stops. And your employer does the same thing. So for every dollar you make, you pay 6.2% on up to the 137.7, and your employer pays 6.2% also for your payroll up to that same amount. If you are self-employed, you pay both. You're going to pay your 6.2 and the employer's 6.2. So essentially, imposing an extra 12.4% tax is what this would be, because that would then kick in over and above the 137.7. And that is certainly a disincentive for high income workers. I mean, there's no question about that. That is a tax that people earning over that Social Security wage base are going to feel right away. That although as an employee, you're only going to feel 6.2% of it, it's certainly still there. And then you tack on top of that the potential 39.6% income tax rate, which is like we had talked about the proposed tax bracket increase. And we're not done. You still have Medicare tax. That's 2.9%. In the current tax code, that continues through. That doesn't have a wage base. 39 plus the 12.4 plus the 2.9, we're at more than 50%. And that math is factoring in some of the costs that may be paid for by the employer. So yeah, if you're an employee, you could take off the 6.2% that the employer is paying on your behalf. But let's be real, it's ultimately borne by the employees, whether it's in less payroll increases and less raises or reduced benefits or whatever it is. Employers have kind of a total economic dollar amount they're willing to pay for an employee, and of course that includes the payroll tax. So yeah, it may be hidden, but at the end of the day, it's there, and it's getting paid, and ultimately it's going to probably fall on the burden of the employee, even if it's not coming out of their pockets. Add in top tax rates for various states. You got California at 13+%, probably even going higher, and now you have net marginal tax rates nearing 65%. So, I think this one is pretty substantial, especially for high income earners who live in high tax states. I guess the question is that likely to pass? Is it likely that even in a Democratic held Senate, that a 65% net tax on in certain parts of the population is something that they're going to put through, especially right now, given the kind of the delicate state of the economy. So I don't know. I think it's probably unlikely that they'd be able to get that through. I do. The other kind of piece to this is that we had talked for a moment about how like they can use this special budgets rule. That doesn't apply to aspects of Social Security. So changing this Social Security tax requires going through what's called regular order in the Senate. And now what that means is this proposal is going to have to most likely go through the filibustering process until it gets 60 senators willing to support it. So now you're going to have people up there talking for days and days and days, essentially pulling a filibuster. I just don't see it happening because they can't kind of use that kind of backdoor way. They're going to have to go through the regular order to change Social Security rules. And I think it's a far stretch. So the bottom line, I don't want to drag this out too much longer, is that a Biden win coupled with a Democratic winning Senate would mean that taxes are going to go up. I mean, we've talked about 5 key areas that are likely to be challenged. But I don't think that all of those are going to happen. In fact, many probably won't. And I also don't think that the ones that could be raised fast enough, or I guess high enough, to generate a recession. So more likely, I think it means that maybe there's a little bit less growth after kind of an early spurt this year. Maybe things cool off a little bit. If you kind of think about like the plow horse pace of the economic growth that we saw in 2009 through 16, or I'm sorry, a slower economic growth that we saw from 29 through 2016, rather than the faster pace we had in 2017 and 19. I think that could be some of those effects. So instead of still having growth, but maybe not necessarily, as fast paced. And then again, I always like to kind of remind everybody that one election doesn't make or break a country. It doesn't make or break certainly an economy. And it doesn't make or break a stock market. And it won't be long that the 2022 midterms are going to be around the corner, and then the presidential election of 2024. And then the discussions will shift towards what's changing next and what impacts do those have. And, electoral votes and House and Senate votes are going to certainly play an impact, and we're going to have to see on a lot of these. But I don't necessarily think that this is a situation that calls for any type of drastic measures or drastic changes, nor do I think that anything too drastic in the tax code is even going to really be easy to get through. I guess the easiest result is a Democratic win in the White House and a Republican maintained Senate, and then I would say we probably throw most of this out because probably not much is going to get changed. But if that's not the case, then I still think that there's a lot of opportunity for things to not change significantly in every direction, nor do I think that even where it does get changed is enough to really derail the stock market or the economy in general. So we will continue, as we always do, to keep an eye on these things. And the important part about tax code changes is making sure that we keep up with them and we find all of the opportunities that are revealed, whether they go up or down, and how that changes your portfolios, your investments, your IRAs, your non-IRAs, And we're always kind of working on that and trying to figure out the best opportunities to take advantages of all the tax laws and codes and changes and rules um, before they get ahead of us. So hopefully that was helpful. And I think that this will continue to be blasted all over the news. There's no question about that. And I also think that negative news and scary news sells a whole lot more than the truth. So I do remind you to take the news with a grain of salt when you see headlines that say Biden's new tax proposals will destroy the economy. Probably not, but that's what they're going to show because that's the clickbait that gets you to click on it. So take it with a grain of salt. We continue to monitor and track what happens here, and we'll certainly know more and more as we get closer to the elections. So thank you all for your time. I appreciate everybody who's been on the call. And if you are listening to this on a recording in the future, we appreciate you tuning in also. Give us a call or a holler or an email or anything if there's anything that we can help with. And we very much look forward to our next economic update and presentation. So thank you all for joining. Have a good day.